Well, it would feel that we're later on in the equity cycle. You know, especially end of last year, we felt that we were near the end. The Fed was tightening interest rates. They were starting to shrink their balance sheet with quantitative tightening. Clearly, that would indicate we're near late cycle. But now the Fed has done a backflip. So the Fed has stopped increasing interest rates and has signalled it's not going to shrink its balance sheet very much further. That's pretty material, which means it's probably going to extend this cycle longer than it otherwise would have gone. So I think we have to appreciate that. This cycle's probably going to go on for longer than I thought it would have gone on maybe third quarter of last year. But we should have some caution here because that length of the cycle really depends upon there being no real inflation in the United States. If it turns out that there is inflation, and often late cycle you do get inflation, we have a very odd period in history that we don't, but there are reasons why we've got a low inflation environment. But if we could go through with such low unemployment and no inflation, this cycle could actually go on for quite a period of time. But it also could come to an abrupt halt as well. So I wouldn't want people to take a high conviction view, and obviously people have become more complacent since the Fed has done its backflip here and markets have been strong and everyone's expecting this trade deal to be done with China and the United States. So we're in a pretty benign environment at the moment, but it could change pretty quickly. But I think we're late cycle, but at the 50% probability, it's probably going to go on for some time, assuming the Fed can hold off any further interest rate rises. At the end of the day, we want a portfolio that has a lot of resilience when things turn down, and at the end of the day, resources are very pro-cyclical, and therefore we've got very limited pro-cyclical budgets. We don't really like commodities in terms of the nature of what we're investing in. It's not a call that people shouldn't have resources in their portfolio, but we're very adamant that we want to have downside protection. And really, if I loaded up on resources in the cycle and then we had an abrupt end to the cycle because we got some inflation, resource stocks would do very poorly at that point in time, and effectively the commitment we're trying to make to our investors is giving protection in their portfolios at that point. It just wouldn't be a good thing to hold, and I'm not smart enough to pick every one of those turning points. So given the nature of what we do in our portfolios, cyclical resources just don't fit into our particular portfolio. That isn't telling people not to own resources in a broader portfolio of theirs. It's just within our global portfolios, commodity cyclical risk does not fit.